Greetings, everyone. I'm very delighted to have Clive Thompson on my channel again, who's our sort of homegrown gnome over there in Switzerland, and he knows how many bees make five. And I follow him, and I'm quite sure some of you do too. But I want to pick his brains a bit today, because we've had similar. We've had sort of parallel universes in our both in our investment career over many, many years, but slight differences in specialization, slight differences of emphasis and stuff like that. So I want to get a second opinion, as it were, and I know it'll be valuable. So I'm going to start off and let Clive have it. But basically, I'd just like to look at portfolio construction, Clive, if I may, because we're old school, or we were old school. We've had to catch up a little bit these days. We were fairly traditionalists, which was the right way over the years. You know, a traditional portfolio always did us well in the long run. But I think times are changing, and I'd just like you to outline how you think things should go from here.
So if we go right back in time to before the times when we had all these strange and wonderful derivative instruments like hedge funds and ETFs and so forth, long before that, the traditional approach to investment was to have 60% of your portfolio in equities, or shares as people know them, and 40% of your portfolio in bonds, typically government bonds, but they could be corporate bonds. That's bonds issued by companies. That was known as the 60-40 approach. And the idea was, and this is again going back to ancient times, we're talking more than 30 years ago, really, as the traditional approach. The idea was, in good times, equities would be going up, but interest rates would be going up as well, which caused bond prices to fall. So your equities would rise and your bonds would fall. And then at some point, you'd go into recession and equities would fall. But because interest rates were falling, that means bond prices rise. So you kind of had this, one would be up, one would be down, and they balanced each other out. And that meant you had what's called a low volatility portfolio. The swings up and down were kind of cancelled out by each side. So you had I won't say it's a straight line, never was a straight line upwards, but it was more of a steady path with bumps along the road, like trying to climb a mountain where you go up, you know what the destination is, it's right at the top, but you're going to be going up and down, but you're going to get to that destination in the end. And it was also quite attractive because way back then, we're talking the 1970s, interest rates were pretty high, double-digit interest rates, above 10%. So it was kind of hard to go wrong in nominal terms if you got 10% coming in on 40% of your portfolio. That gave you every year if it was 10%, that gave you a head start of 4% because you had 40% earning 10%. That gives you 4% gain. And then your equities would go up or down 10 or 20%. So you might have a loss or a bigger gain. That was the traditional approach. And that worked for many, many years until we got into the global financial crisis, where interest rates around the world effectively dropped to nearly zero. And that meant bond yields, which were tracking closely interest rates, were very close to zero. They were typically, well, in Europe, they were negative. In the UK, it went negative for a while. In the USA, it went negative very briefly. But the rates, if we talk about the period from 2008 to 2015, we're talking about rates of 1% on bonds for a long, long period. Now, that meant that if you had a 60-40 portfolio, you were barely making anything on the bonds, and especially after paying the fees. Don't forget, every portfolio manager charges a fee. On the bond, on 40% of your portfolio, you were effectively in negative territory. And then came the period after that when interest rates started to rise around the world. Now, rising interest rates generally translate into falling bond prices. So it became, if you would have stayed, and many people did, in the 60-40 approach, we turned into a situation where the returns on 40% of the portfolio were going negative because bond prices were falling. The question now is that model dead and gone? And if so, why? And what should you do about it? Well, I've got the answer for all of that, Godfrey. But shall I just pause there to see if you've got any comments or questions?
Yes, thank you. That's a good sort of historical briefing, and it was something that we all brought up in the city. I mean that's how it was. That's how it was. And the margins, of course, were on equities, where if you had a very good equity manager, he could outperform. And we both know how rare that was, outperforming the index, maybe for a year or two, and then fall away if somebody's overweight banks, as we've seen, in the past. And of course, the other thing is when I was lecturing at doing corporate training, working for a big investment bank in the city, sometimes was trying to sort of explain to lay folk why rising interest rising interest rates in bonds leads to capital depreciation, and that's something people used to struggle getting their heads round. But of course, if basically speaking, if you've got a bond with a 5% coupon, and this year's coupon is 6%, last year's bond is not so attractive, so it goes down, and that is something that's difficult. And one other thing I just like to chuck in quickly, we're talking about, oh dear, the T bond or the long bond or the 10-year bond is nudging 5% in dollars or whatever it is. Well, of course, I well remember, and if you're reading your books, and even if you're reading your Trollope, or your Dickens, or whatever it happens to be, the coupon, the ideal with a bond is that the coupon makes you should at the end of the year have your bond should be in positive territory. Well, of course, if you've got inflation and you've got falling or rising bond yields, it goes down. So it's not the safe haven that one would imagine it was in the time of Dickens, as it were. So this is one of the major things that times have changed, in my view. Bonds, gilts, T-bonds aren't what they were, or even close to what they were.
You're right, Godfrey. They have, because of the change in the world with government debts at record levels and going at a faster pace compared with the economy in terms of the debt rising, we're in much more dangerous territory, risky territory, I would say, for those who hold bonds of all descriptions. And the longer dated, the longer maturity bond you have, the bigger the risk is that you could lose a lot of money. So just to make it very, very simple, if you have a 10-year bond and the yields on bonds rise by 1%, that means by the one you bought before, the 10-year bond, you're going to be 1% worse off for the next 10 years. So your bond, in theory, should be about 10% lower in price. But now imagine it's a 30-year bond and yields rise by 1%. Your bond price is going to drop by 30%. And so the risk for investors these days is what's going to happen to yields. And if we do enter a higher inflation environment, and all the signs are that we should go in that direction, then the risk is of serious drops in bond prices. I'd like to come back to something you said about outperformance or non-outperformance of the market, Godfrey. Back in the before the internet existed, and that sort of a gradual process from about 1990 through to about 1999. Outperformance of the index was possible by those who had the information, because the information wasn't available to everybody and their brother. You couldn't just go to a Google. There was no Google. You couldn't just Google and say, what are the results of this company or that company? What I was doing back in the 1970s and 80s, or at least when I was in the UK, was going to the only way I could get financial information was to go to the London Business Library, where they kept something called Excel cards. I was always the only person who ever looked at these Excel cards, but the Excel cards had for every UK company the latest earnings report, what its revenue was, what its earnings were, what its price earnings were. So the kind of financial information you get online now, but it was on a paper card, and these cards would arrive at the library. The librarian would take out the old card and put in the new card, so you could see the last 5 years' earnings, last 5 years' sales, and things like that. So I had special knowledge that most people did not. And we didn't have back then the kind of machines that we had later on, like Reuters and Bloomberg's, and those sort of things just didn't exist. So the only way to get financial information was either to visit the company itself, something I didn't do, but many people did, and get the inside information out of the management, or to order the annual report from the company, which many people did, and I was doing a lot of that, or to go to the business school or somewhere where you could get the Excel cards and read them and figure out what the companies were doing. Of course, with the arrival of information everywhere, which sort of happened between the year 2000 and today, it means that anyone can find out almost anything about any company, any publicly disseminated information at the same time as everybody else. So that competitive advantage has largely gone away, and we're seeing that portfolio managers struggle to outperform equity indexes. I do myself. And there's another problem which has come into the fray for investment managers, and that is that the old investment styles, the styles of the likes of Warren Buffett, Ben Graham, and so forth, are now severely challenged by the masses who don't know the difference between value and price. And because we now have accessibility to a far wider group of people than we ever had before. You know, when I was young, stocks were for the landed gentry. It wasn't for every man in the street. But now stocks are, in theory, available to every man in the street if he wants them, which means that there's a lot of speculation. We only have to look at how high SpaceX is going on the back of lots of people love Elon Musk, but there's very few shares in circulation. The price goes up and up, despite the fact a large number of investment managers don't really think they're worth the price at which they're trading. So it's become a lot harder because for the average investment manager, he's torn between, do I follow the crowd and behave like a lemming and do what everybody else is doing and buy stuff which I don't believe in? Or do I behave like Ben Graham and buy the stocks I can buy but at a price below what they're really worth? I want to buy price below value. Well, if I do that, I'm sitting there watching the lemming stocks go to the moon, while my stocks, which are the most sensible ones, aren't rising at all. So the dilemma for the portfolio managers, what do? Do I jump in like the lemmings and do the same thing as everybody else, and therefore I'm part of the crowd and keep my job? Or do I go out on a limb and pray that traditional approach to investing will come back somehow, and the crowd will have some kind of reversion to the mean? We don't know which is going to happen. So has the 60-40 approach gone out the window? Definitely it has. I think the way forward now is to have a larger exposure to gold in the portfolio. And to prove this, I built a portfolio tool on my website, clivethompson.com, which any of your viewers can go to. It's free of charge. I don't require any payment. I don't need an email address. There's no login. I don't even need to know who you are. You can go to clivethompson.com and put into the portfolio simulator any asset allocation you like. You could put in 60-40, 60% equities, 40% bonds, and you can choose which bonds, government bonds or UK gilts or European bonds. You know, any market you like. You can put in the FTSE 100 or the S&P 500. You can put in the consumer price index. You can put a retail price index. You can put in all the property indices. But bottom line is, you can make your own portfolio and see how it would have performed from any date you like. Now, this is quite interesting because you can play with lots of different types of portfolio to see how they would have done since 20, 30, 40, even 50 years. But what I did test, Godfrey, was the 60-40 portfolio against portfolios which contained gold. What I've managed to prove, and there's absolutely no doubt that this is right, that over every period, any starting date you like until today, having some gold in the portfolio would have improved the performance overall. It would have reduced the volatility. It would have reduced the maximum drawdown. A drawdown is the price when something goes from a portfolio goes from peak to trough. So it would have reduced the maximum drawdown, and it would have improved what's called the Sharpe ratio. The Sharpe ratio, for those who don't know what a Sharpe ratio is, a tool used by portfolio managers to manage the amount of return you're getting for the risk you're taking, risk being defined as volatility. So the higher the Sharpe ratio, the better your portfolio. So you can have a higher Sharpe ratio for something which performed less well, because it was much less volatile. So, but at the end of the day, a portfolio manager is always looking for the best Sharpe ratio, the highest Sharpe ratio. So adding some gold to any portfolio in replacement of the bonds or partial replacement bonds, always over every single period, improved all of those things. So the question is, what is the optimal amount of gold? Now, Morgan Stanley recently came out and said the 60-40 portfolio is dead. The new norm should be 60-20-20. They're thinking 60% in equities, 20% in bonds, typically government bonds, and 20% in gold. 60-20-20 is they're saying is the new norm. So I put that to the test, and absolutely they're right. A 60-20-20 portfolio would have outperformed over every single period on every single metric. But I went further to test it over lots of different scenarios and different periods. Now, the exact mix you should start with, or the optimal mix you should start with, does depend on your starting date. So your starting date in 1971, for example, it would have been optimal to have a different mix from a starting date, what the mix you'd have in, let's say, 2021. So I tested over every period all the mixes, but the conclusion was no matter what you mix you take, having some gold was a great thing. But so back in the 1970s, a 60-20-20 portfolio right through to today would have been a good thing. And to test it, I did what's called rebalancing. Rebalancing means every year you rebalance the asset classes to their original percentage. So if it was 60-20-20, but you get to the end of the year, equity has gone up and bonds have gone down, you might be at 70-10-20 or something like that. You rebalance back to 60-20-20 by selling some equities, buying some bonds. So you're at that optimal level every year. So that's called rebalancing. So on my website, you can test this with annual rebalancing or quarterly rebalancing or rebalancing every 2 years if you want. And you can test it throughout the whole period from 1971 to today's date or any other starting date. I tested this through multiple scenarios, but the optimal mix that I came to, Godfrey, have a guess what the optimal mix, if you take any starting date, what would have been the optimal level to choose if you had to say, I don't know what the starting date is, but I have to choose a mix of equities, bonds, and gold. And you could say 60-20-20 or 60-30-10 or 60-10-30 or 60-0-40, whatever you like. What's the optimal mix that you could have chosen over time if you don't know what starting date I'm going to choose?
Well, if
Have a
I was
guess.
going to guess at that, and it's a wild guess because nobody's asked me that before, certainly I would go back to perhaps the traditional portfolio. If you took a traditional portfolio, and I go back much more than 30 years now, you would expect to have 5% in gold. Well, if you had 5% in gold, if you want to go back to to the Edwardian era, that would give you your optimum, I would think, perhaps your optimum spread. But I don't know. You're the man with
Well,
the homework.
you're obviously on the right track because actually, the further back in time you go, the less gold you really needed in the portfolio. So you're kind of right when you say going back to the Edwardian area, maybe 5%. But as we go forward in time, it makes sense to have more gold. It would have made sense to have more gold in your portfolio. If you don't know what the starting date is, the optimal amount to choose today, and you're going to be shocked back in time, would have been 60 in equities, 10 in bonds, and 30 in gold. And that's based on every period starting from 1971. So starting 71, 76, 81, 86, 91, 96, 2001, 2006, 2016, 2021 would have all, with 30% gold and 10% bonds and 60% equities, would have all produced a better return than your 60-40 portfolio, a better Sharpe ratio, a lower drawdown, and lower volatility. That would have worked for every single period. But as we go to the more recent years, starting from 2016, I think it is. I'm just looking at my portfolio simulator on clivethompson.com now. Just bear with me for a second while I bring that up. The optimal from 2011 onwards, your optimal exposure to bonds would have been zero. So from 2011, your portfolio should have been at least 30% equity, 30% gold. Now, when I say that at least, because it does depend on when you start, but let's say you started in 2011, you should have had 65% roughly in equities and 35% in gold. Starting 5 years later, you should have had around 50 in equities and around 50 in gold. And starting 5 years after that in 2021, you should have had only 35% in equities and 65 roughly in gold. And all those periods, zero bonds. Go back to a little bit more to 20 years ago. 20 years ago, the optimal would have been roughly 50% equities, roughly 10% bonds, and roughly 40% gold. But my point is, there's no period when gold would have been a bad investment. It would have been a good investment in every portfolio over every period.
It was funny because I was obviously in the city, so was very equity based, of course, up until 1990 or the mid 1990s, 1997, 1998. My personal portfolios and in wealth management were all heavily equity. And when I retired from that part of my financial life, as it were, I put all my personal portfolios, I went 100% gold, which breaks all the rules. In 1999, I went 100% gold. And something here I'll just mention for subscribers watching, both ours, people watching. You will find, you'll go, right, that's interesting. You will find distinct in the United Kingdom, distinct hostility when you suggest to your financial advisor or your portfolio manager that you pick up that kind of percentages. He will not like it. Professional fund managers in the city do not like gold. That's point one. For the start, it's not regulated, so it's not within their orbit, as it were. It's not really what they do. So they like the 60-40 and they can tweak it around and so on and so forth. So you will get hostility, and you get hostility if you are a retired surgeon or something like that. You will bump into that hostility. Now, in the United Kingdom, of course, if you buy coin of the realm, if you buy sovereigns, which are internationally recognized, of course, and you get delivery in specie, you have no capital gains tax, and you have all the other sort of facilities. What you will be pushing down, you want gold then, Mr. Thompson, right? I've got the ETF for you, or some derivative or something. You don't want that. You do not want if you want gold in your portfolio, you have to hold it in specie, you have to hold it in your hand, or if you're getting quite a significant amount, it must be an independent vault, not a bank, an independent vault for you as well. It also, you might argue, that might get me into trouble, you take it off the table. And when you live in a kleptocracy, which is the United Kingdom at the moment, they can't see it. So you only got to go a year or two and suddenly it disappears like Scotch mist. So it is very good thing to hold. I just put that in for the UK subscribers because that's something that they need to know. And I'm sure you've been in the same situation when people get in touch with you and say, my financial advisor thinks I'm mad. I'm not allowed to have it. I can't go there. He's trying to sell me something like an ETF. So I just thought I'd chuck that one in, Clive.
So, Godfrey, what you've just said is extremely good advice for UK listeners because, as you say, it's better to hold a capital gains tax-free investment than one which does the same thing, but on which you would have to pay capital gains tax. Why do portfolio managers hate putting gold in the portfolio? Well, it's very hard to justify charging somebody a fee if you're holding gold, because the client's going to turn around and say, well, if all you're doing is holding gold, thank you very much. I could do that myself. I don't need you to charge me a 1% fee to have gold in the portfolio. So that's one of the reasons why there's a lot of hostility against it. But of course, portfolio managers will also argue that it's a very hard asset to value on the grounds that it doesn't produce any profit in terms of cash flow or any income. But they don't have to look at it that way. They have to look at the fact that it is producing a return because the amount of money and the amount of government debt on the planet continues to increase at a very rapid pace. And when that happens, the trust in the currency goes backwards. And when the trust in the currency goes backwards, the desire to hold something which will hold its value goes upwards. In other words, the higher the government debt inflation, the more people are going to cross that border from saying I need to be in bonds and equities to say I need to be bonds, equities, and gold. So as the inflation rate, when I use the word inflation rate, I'm not talking about the consumer price index or the retail price index. I'm talking about the inflation rate of government debt and money supply. That's the increase of wealth, if you like, a fictitious wealth, because the government's getting, as the government borrows money, the government's getting poorer. It's just that everybody else is getting richer because the government borrows money, spends it. That money which they spend flows through to the hands of the wealthy. They get richer. So those richer people aren't going to be bidding up the price of sausages, eggs, and pizzas. They're going to be bidding up the prices of the things which are desirable, such as equities or gold, and which are in relatively short supply, where the supply can't be increased by too much. So that's why we have the prices of hard assets, property as well, increasing over long periods of time by faster than would appear to be justified by the consumer price index or the retail price index. And that's not about to change. That's not about to change. And the reason it increases faster is because although there's a lot of these other assets out there, like equities and gold, most of what's out there is not available for sale at any price. It's because most of the gold is held by long-term institutions who aren't holding it to trade it tomorrow for a $10 or $100 profit. They're holding it either permanently because they're a central bank or generationally through countless generations. It's the last thing they'll ever sell. So that's just not available. So the much smaller amount, which is available for sale, whether we're talking about gold or equities or whatever, you don't need a great deal of people to be net buyers to push up the price of that small quantity which is available for trading on a day-by-day basis. Now, I know the volume of stocks is absolutely mammoth, but it's still a fact that the vast majority of stocks never change hands. They're held in very, very tight hands in pension funds and long-term holders and the original founders who never sell. So it's just the stocks which are in the trading portfolios which are moving around. And of course, the portfolio managers could easily justify their fee if they're trading stocks, because they say, we're charging a fee to put you in the right stocks, but you can't charge someone a fee to put them in the right gold. What color gold do you want?
You would have heard that probably, I'm not sure of this apocryphal story or not, but it's one that we used to enjoy in the city many years ago with traditional stockbrokers and fund managers, was that they had a widow client who had her own stocks in a drawer, and she had the same stocks in the drawer for somewhere in the region of 30 years. She'd inherited them from her father, some BP stocks or some whatever stocks it was. It was a sort of a bundle of stocks. And it had outperformed anything the company had done. It outperformed anything the city had ever done. And she just, by default, bought them and held them for 30 or 40 years. And the dividend was automatically reinvested. But now I'd like to move on to just a little bit the elephant in the room when it comes to institutional fund management, which was really my main background, and that is commercial property, which certainly in the pension fund world, and I think I think a lot of this is going to still have not come home to roost yet when it comes to certainly defined benefit scheme, which of course aren't funded these days in the United Kingdom. But the point of this is, you thought you couldn't go wrong with a skyscraper if it was in EC3, the old Kleinwort building, which they've now knocked down and built an even bigger one. Unbelievable. I've seen the first major skyscraper in Fenchurch Street in the city. I saw it built and I've seen it come down. That's what happens when you're old. You see it go up. Happens in New York all the time. So the point is, that would have always been a rock steady or a mall. The old story, if you've got a shopping mall and the first people you want is Marks and Spencer's in it, you want a key prestige people. Mark to market, I would guess, and this is not my field, incidentally, I would argue has taken a much bigger tumble than portfolio valuations are showing at the moment, or would you not agree?
Godfrey, you're right for several reasons. First of all, there's the reason that everybody knows, which is office work is diminishing. With everything which is going on with the work at home following or during and now after the pandemic, offices are less full than they used to. Now, most offices still want their staff back in the office 4 days a week and 1 day work at home, but that's still a 20% reduction. And there are offices and businesses where they say we don't need anybody in the office at all. So first of all, we've got due to the rise in technology and the ability to work at home, we've got less physical bodies in the room, which means you need less floors, less desks, and therefore the demand is not as high as it was, or at least not at the old rent. The second thing we've got going on, Godfrey, is interest rates. Many of these buildings were bought, they're called the commercial properties, the office blocks. They were bought with borrowed money 5 or 10 or 15 years ago. And the loans, don't forget, I talked about the interest rates being effectively zero. Well, it wasn't zero if you borrowed money 5 or 10 years ago, but it would have been very low. So let's say the LIBOR rate, which is what they would have been using back then, let's say the LIBOR rate was 0.5%. You would have been paying maybe 3.5% in interest to borrow money. And you'd be collecting rent, let's say, which is worth 6 or 7% of the property value. And the more you leverage up, the higher your net return goes. So after allowing for the borrowing, where you're earning, let's say, 6 and paying out 3, with a bit of leverage, you can get 9% on the net capital invested, or 10% even. Well, interest rates have now gone up. Let's call the interest rates now 4%, which means that you can't borrow money at 3.5% or 4% anymore. You've got to borrow money at 7%. So some of these loans, which were taken out 5 or 6 years ago, or 10 years ago, at a fixed interest rate, are now arriving at their maturity and have to be rolled over, if the bank will allow it, at a much higher interest rate. Now, in the interim period, you may have put your rents up, but your rents might have risen by 20, 30, 40%, but your interest rate is going from 3.5% to 7%. It's risen by 100%. So your net return is going to be much less after allowing for the higher interest rate and allowing for the slightly higher rentals that you're now getting. Your net return is going to be much lower. That means that a buyer of your property isn't going to be paying you what you paid, because whereas if they had done that 6 years ago, they'd be getting a 9% return. Now they're going to be getting a 1% return or 2% return because the interest rate's higher. So they're going to say, the only way I can make this work is if I pay you half what you paid. Because by paying half what you paid, I can borrow half as much, and then it starts to work again on the new maths. What does that mean? It means the property value is only worth what the next buyer would be willing to pay, and they're not going to pay what you paid because their net return, allowing for the leverage and the interest rate being much higher, is going to be much lower. So the next buyer will only be willing to pay a much, much lower price, and that's the new value. So the new value of many of these properties is considerably less than what it was due to the change in interest rates. So we've got that problem, and of course now we've got this, as I said, the shrinking number of people going to the office every day. The amount of space needed is no longer there. So yes, these commercial portfolios, which are held through all kinds of vehicles and probably in your pension fund as well, or maybe not your pension fund, Godfrey, I'm sure you've got yours out, but those who still have pension funds, they'll have a figure on the face of the face value of the asset, which is what they paid for it. But reality is it's probably worth less.
I think that's obviously true, because that's just a matter of arithmetic. But it's also I don't think anybody's really quite faced up to it. It's a funny old thing that people, when they're in a traditional investment situation, it's very difficult to winkle them out. I had lunch with a very wealthy man the other day, not a client. He'd made his money in a company. I won't bore you with the details. Very nice man, about 60, I suppose, 60 years old. And I didn't mention gold at all, but he knows I'm a bit of a gold bug because I publish articles and stuff like that in the same way that you do. And he said, "Oh, I don't like gold because there's no yield." I could hear that was an echo his financial advisor had told him that. Or his accountant. I didn't get into an argument because he's the sort of man you don't argue with. You really just don't. Not because he's an unpleasant man. He's just blinkered. He is completely and totally blinkered. He doesn't understand these matters. But I know that I could have, if I just said, well, let's say you've got an equity and bond portfolio. There's a yield. Let's say being generous, so there's a 4% yield on your overall, an annual 4% on your portfolio. First of all, it's taxed. So you're going to lose your dividend yield. That's going to be cut in half virtually by tax. Let's say that you're getting 2% on it net, which, and I'm being a little bit generous under the UK tax system. Let's say you're getting 2% in real terms. What do you believe inflation is? What's your take on it? Let's take CPI. Nothing wrong with CPI. Take it. We know it's fake, but I mean, let's take what the government say what it is. CPI. Let's say that it's 3% or 3.5%, which we know is bullshit. But let's say you're losing 1% of your portfolio every year. You know that.
And when he retires in 40 years' time, how much of his portfolio will he have lost in spending power?
Damn near all of it.
Yes, exactly.
But there's no telling him. I couldn't tell him that. It would be a waste of time, waste of my breath. But now, one of the big bees in my bonnet, which is why I want to bring you onto your books. One of the big bees in my bonnet. Two things really. One is that people aren't talking about money or investment at school, and they should be. That should be at school. They shouldn't go into the workplace at 16 or 17. Forget university, forget all that. At 16 or 17 without understanding money. What is money? How does it work? How do banks work? Etc., etc. They know absolutely nothing. In the same way, and this gets me into trouble because I'm a bit labelled as a misogynist, they've stopped doing domestic science for girls. Now, girls, I got girls watching this, if you're a young girl, I shouldn't think many young girls watch my channel. If you want to hook a decent bloke, make sure you can bake. Because at the end of the day, your hubby will want a nice meal, and if you can do that, nothing else is going to really matter to the average bloke. So now, everybody, Clive has got a series of books he does for children to get into their teens, to grow up with this idea. And I topped it with my book. There's a lot of you, if you're my subscriber, you've probably all got it. Magic of Acting for the Professional Man Who Starts in His 20s. Everybody should have a learning curve when it comes to money. So this, I think, is the starting place with Clive Thompson's book. Tell us how you start them off with your books, Clive.
So I've written a series of 5 books called the Little Trot series. The first one is called Little Trot Learns to Save Money. It started out by me thinking I need to write a book. Well, I was going to do a video about the global financial crisis, and I started doing some pictures. And as a consequence of the pictures kind of turned into a book for children about the global financial crisis, except this is not about the global financial crisis. It's about the Toy Town financial crisis. This is book 1. So in this book, unfortunately, Little Trot, he does deposit his money in the bank. But unfortunately for him, the bank manager lends it to the goblins to whom he should never have lent it. And what does that mean? The goblins can't repay, and we have a Toy Town financial crisis. So the question is, does Little Trot get his money back or not? Well, there is a happy ending, but I'm not going to tell everybody how it ends. But they can go to my website and get the book absolutely for free. I've got nothing to sell here. This book is free of charge on my website, clivethompson.com. You just go there, you'll find it very easily. Download it in PDF and look at it on your iPad or your laptop with your little ones. There's lovely pictures. Every picture's, I've spent days on every picture. Beautiful detail, lots to talk about on every picture, and the children will love it. And when they've read the book one, there's book two, three, four, and five out there. Book two is called Little Trot Learns About Inflation. Book three is called Little Trot and Little Trot Invests in Stocks. Unfortunately, he invests in a rocket company because he's very excited about the idea of rockets going to Mars. And that unfortunately ultimately fails. And he realizes the error of putting all his eggs in one stock. But there's a happy ending. Little book four, which you like, Godfrey, is called Little Trot and the Great Gold Rush. Now, in this book, Little Trot starts to learn about money and discovers that there's gold found in them there hills. And off he goes. Well, before he does so, he starts to ask questions about gold and learns all about gold and the history of gold, which you see here. There's a bit of a history there. He learns about the history of gold. And there we are. He's learning a little bit there with his mentor. And then off he goes to dig up the gold in the mountains. Here he is digging the gold. But unfortunately, doesn't find any gold. Has lots of adventures when he's in the mountains with the goblins and the badgers and other things. But eventually he discovers a magic formula to make some money. You can guess what it is. Selling the shovels to the gold miners.
Yeah.
And book five is called Little Trot and the Goblin Tenants. And unfortunately, he rents his property to the goblin tenants who leave the place in a wreck after not paying the rent. So children who read these books will learn lots of interesting words involving finance. They'll learn, what is rent, what's a deposit, what's a tenant, what's a landlord, what's a withdrawal, what's compound interest, what saving is. They'll have a lot of vocabulary which I did not have at the time I left school. I came out of school, went straight to a bank, not knowing most of the vocabulary words, which I should have known. Now, as I worked in my career, 50 years I was working, and I was advising wealthy families on investing their money, I realized that many of these people are very, very intelligent in their own area, but many of them still feel insecure when it comes to talking about money. They still didn't know the cause of inflation. They felt unfamiliar with the terms like stocks and how does a stock work or how does a bond work. You described it earlier. People didn't understand the relationship between the yield and the price of a bond. So I spent many years, not many years, every year, describing to wealthy clients how these things work and how to put together. So I realized that it's not just children who haven't been taught this. It's all the way through until people retire. They've retired, they've got the money, and they're not sure what to do because they don't have the confidence because they never had the vocabulary to start with. So these books are not teaching children what to invest in or anything like that. This is not an investment book. This is just placing the vocabulary in the minds of children and giving them some examples of things which might go wrong. You might rush to the hills to follow the gold rush to dig up the gold when it's not there, follow the crowd or not. But then Little Trot finds the alternative plan B to sell the shovels. So every book has its solution to its problem. But what I want to achieve here is that get this into the hands of families because it is creating a discussion between mums and dads and their children. Suddenly the older children are starting to embarrass their parents. And I don't mean that in a bad way. I mean in a way which the parents are very pleased to have that conversation because children are saying to their parents, Mummy, Daddy, have you borrowed money from the bank? Are you going to repay them? And things like, have you ever been bankrupt? Do we own our house or are we renting it? They're pleased to use grown-up words, which they never used before, and now they're showing off their grown-up words. So that's what these Little Trot books do for the children.
I think it's absolutely first class, and I shall certainly put a link on my website for them. Because I think I'm a true believer in this as well, and I think that's really quite exciting. And by the way, I'm a big supporter as a lot of my subscribers know, in home education. I cannot think of a better way of helping your child with home education than these books. That will really bring them forward on a subject that brings a level playing field, and they're actually giving them an education in something which they're not getting at the local school. They're
Yes,
not getting it. So
when they come up,
it puts your children ahead.
the schools say there's only three things you need to know when you come out of school. That's reading, writing, and mathematics. All the rest, which you've learned, biology, history, science, physics, might be useful to a small group of you, but the rest of you, everybody has to know reading, writing, and mathematics. Well, hang on a minute. What about money? You come out of school and you don't know whether you can't compare the benefits of leasing a car with borrowing to buy it. Or if you're going to go to the shop and buy an iPhone, the shop's going to say it's only £25 a month. Well, is that a good deal or is it a bad deal compared with paying for it with your credit card? These are things which children have no clue. They've not been taught, and that the fourth subject when they come out of school should be money. So it should be reading, writing, mathematics, and money. Everybody needs that. Not everybody needs biology. Not everybody needs physics. Not everybody needs history. But I mean, it's good to have it. But at the end of the day, it's not a non-essential subject for survival. Money is essential for survival in today's world.
Would Rachel Reeves understand your books? Or are they just a tad too advanced, do you imagine?
Well, they're really designed for children with at least 6 years old, Godfrey.
That puts her in the cold.
But I have heard that it works for everyone from 3 to 103. So I do think she would learn a thing or two, especially about inflation. The book Little Trot Discovers Inflation would be a great one for Rachel Reeves.
Send it to her, sign it for her and send it to her for a bit of a lark and see if you get a response. Now, well, I've taken enough of your time, Clive, and I know how busy you are, and I thank you very much for it. Just let's to remind ourselves how to find you. Is it just clivethompsons.co? Just remind me of your...
Those who'd like to write to me have two ways of doing it. They can write to me on LinkedIn, or on my website, I've got a section called Ask Clive a Question, and it's very easy to write a question there. The website's called clivethompson.com. My name, Thom Pearson.
That's it, everybody. You've got it now, straight from the horse's mouth. Follow him. I do. You should. Very interesting to talk to you, Clive, and I thank you once again for your time.
Thank you, Godfrey. Thumbs up to all your viewers.
Thank you. As most of you know, my work is very heavily independently research-based, and I get my information from all over the world. It would help if you press the subscribe button and the little bell next to it, because the more subscribers I have, the more likely it is that international independent research institutes will share their material with me. It's most helpful, and then of course I automatically share it with you. So, surprise, won't cost you anything. Thank you very much.